So let's expand our definition of taxes, right? So we've been talking about corporate taxes. Now let's look at the taxes that are paid by investors. And of course, cash flows to investors are typically taxed twice. The company pays taxes, and then investors are taxed again when they receive their interest or dividends. So again, interest payments, they have a tax on interest income. And of course, they also have tax on capital gains and dividends as an investor, as a shareholder. So the amount of money you pay for security depends on the cash flows you receive after the tax has been paid. Again, personal taxes reduce the cash flows to investors. They do offset some of the benefits of leverage then. So the actual interest tax shield depends on both corporate and personal taxes. So we need to find out the true benefit of leverage. So we end up with a formula now that takes the tax shield and converts it to incorporate corporate taxes, T sub C. T sub E is the tax on equity. T sub I is the tax on interest. So this ratio, 1 minus this quotient, is effectively the tax shield, right? So all we're doing is taking this formula that was the value of levered is the value of unlevered plus T sub C times D, right? This is now changed to this when we include the personal taxes of interest and debt. So if there are no taxes, if there's no personal taxes on debt income, right? If T sub I equals 0, then the personal tax rates is just this numerator, 1 minus this product. We end up with T star, this tax advantage here, being equal to TC. So this just takes us right back to the other formula we had, which was that previous formula, which had the tax advantage. That's the formula we get. But what happens if the numerator equaled the denominator? Then this equals 1. It's 1 minus 0. So then we're back to the first equation, which was the value of the levered firm is equal to the value of the unlevered firm. So now what we basically have is we need to have an understanding of the relationships. If equity is taxed less heavily, which currently it is, then T sub E is less than T sub I. So then we're going to have an outcome, if you will, that we can now graph. So this, the red line, this is V sub L equals V sub U minus T sub C times D. But when we incorporate the personal tax rate, again, it cannot be any less than this. It can't be less than this. It can't be any more than this. So in reality, it's just somewhere in between, right? I don't know exactly where it is. It will depend on the relationship of the tax code. So currently, corporate taxes are around, T sub C is around 21%. T sub E is in the ballpark of 15%. And T sub I, depending on your marginal tax rate, could be as high as like 38%. So this is a picture of roughly what our current tax codes look like. Now, of course, depending on the person, their marginal tax rates will change. So we don't know exactly where this is for any one person. So we're looking at what do we think this is for the average corporation. So what we want to do is look at this actual tax advantage, right? We figured out here the effective tax advantage, right? However, it's unlikely that all or even most investors, as we said, is actually taxed at the highest rates. So it was assumed that investors paid capital gains every year. Well, that's not true, right? Capital gains taxes are paid only when you sell a stock. So really that gain is realized, but it's not recognized. So deferring the payment of capital gains taxes lowers the present value of overall taxes, right? So again, this can be interpreted then that, again, the more capital gains you have, the further out the tax burden would be, which means there'd be a lower effective tax rate. If investors have accrued losses, right, they could actually face a zero effective capital gains tax rate. So investors with long holding period or losses, again, face a lower tax rate on equity income, which again decreases the effective tax advantage of debt. Again, we also assumed that shareholder gains would be evenly split between dividends and capital gains. For firms with much higher payout ratios, right, this average, wouldn't be accurate. So depending on the ratio of payout, we also have some differences in the actual tax advantage. Again, we assume top marginal federal income taxes. In reality, most people have much lower tax rates than that marginal amount. Some investors pay zero taxes, right? So if your investments are all in retirement savings, they're not subject to taxes. So for those investors, this effective tax advantage is the full corporate tax rate. So the bottom line of this is, if you're thinking about how taxes affect the investment, right? Calculating the effective advantage, the actual advantage, is pretty difficult because it's based on individuals, right? So a firm has to consider the tax bracket of its typical debt holders, right? So the tax advantage to debt is going to vary across firms and from investor to investor. So let's see what happens in the next video.